Welcome back, everyone. Today we're diving into something wild. Michael Saylor might be synthetically having Bitcoin. You've heard about Bitcoin halving, right? The event that cuts miner rewards in half and historically sends prices soaring. But what if one of the biggest Bitcoin whales is creating the same effect without waiting for the blockchain to do it? Stick around, because we're breaking down exactly how this works, why it matters for the market, and what it could mean for your portfolio. Bitcoin halving is one of the most talked about events in the cryptocurrency world, and it usually happens every 4 years, reducing the reward miners get for validating new blocks by 50%. This event is significant because it directly affects the supply of new Bitcoin entering the market, and historically, it has often been associated with major price increases over time. The idea behind halving is simple. Fewer new coins coming into circulation creates scarcity, while demand remains the same or grows, which can push prices higher. But in this video, the focus isn't on the official blockchain halving. Instead, it's about something called synthetic halving, a concept that might sound complex at first, but is surprisingly intuitive when you break it down. Synthetic halving is not an official reduction in miner rewards or a protocol change in Bitcoin. Rather, it is an effect created by large players in the market who accumulate and hold Bitcoin on such a scale that the circulating supply effectively decreases. When someone like Michael Saylor, known for his massive Bitcoin holdings, continues to buy and not sell, the number of Bitcoins available for others to trade shrinks, creating scarcity in the market. This is similar in effect to a halving because fewer Bitcoins are actually available for buying, even though the total supply continues to grow according to the blockchain's schedule. From a market perspective, scarcity often drives price appreciation because people are competing for a limited resource. What makes synthetic halving so fascinating is that it doesn't require waiting for the next scheduled halving event. Instead, it leverages the psychology of the market, the behavior of investors, and the concentration of Bitcoin holdings. When influential individuals accumulate Bitcoin, it sends a signal to the market that this asset is valuable and worth holding. This encourages other investors to buy in, amplifying the scarcity effect. Essentially, synthetic halving is about creating a perception of reduced supply through action, not protocol. And perception is a powerful force in financial markets. It is also important to understand that this concept relies heavily on the actions of whales' large holders, with significant influence over supply. Unlike traditional halving, which is predictable and baked into Bitcoin's code, synthetic halving is influenced by human behavior. And while it can produce similar outcomes, it's subject to change depending on how these major players act. The mechanism behind this synthetic effect involves holding Bitcoin off exchanges and in cold storage or private wallets. When Bitcoin is locked away and not circulating, it's as if it's temporarily removed from the market, limiting supply and creating upward pressure on prices when demand remains steady or grows. Investors watching the moves of these whales often adjust their own strategies accordingly, buy in before they anticipate a surge in price. This creates a feedback loop where accumulation by large holders encourages more buying, which further reinforces the scarcity effect. Understanding synthetic halving also requires a shift in thinking about market dynamics. Instead of focusing solely on the blockchain's scheduled events, it emphasizes the real-world behavior of market participants and how strategic accumulation can mimic protocol-driven scarcity. In other words, synthetic halving bridges the gap between human psychology and algorithmic supply controls. It's a reminder that in cryptocurrency, the market isn't just a mechanical system. It's also a social system where perception, strategy, and timing can produce powerful effects. This concept also highlights the role of timing in investing. By observing and understanding how whales like Michael Saylor act, smaller investors can anticipate trends and position themselves in ways that take advantage of these supply-driven dynamics, even without waiting for official halving events. The result is a unique form of market manipulation that isn't illegal or unethical, but demonstrates the influence that large holders can have on asset prices, creating scarcity effects that mirror natural halving events. When most people think about Bitcoin and supply, they immediately focus on the blockchain and miner rewards, assuming that the only way scarcity affects price is through scheduled halving events. But the truth is that supply pressure can exist outside of these protocol rules, and this is where the concept of synthetic scarcity becomes so intriguing. Large holders, often called whales, have the ability to influence the amount of Bitcoin that is effectively available for trading. Even if the total supply continues to grow according to the blockchain schedule, When a whale like Michael Saylor decides to accumulate Bitcoin on a massive scale and chooses not to sell, a significant portion of Bitcoin is effectively removed from circulation. It isn't burned or destroyed. It's just held in private wallets or cold storage. And this action alone can reduce the coins available for other investors to buy. This reduction in circulating supply creates what we call supply pressure because there is less Bitcoin available for buyers. And when demand remains the same or increases, prices naturally feel upward pressure. It is a simple economic principle. Limited supply plus steady or growing demand tends to increase value. The interesting part is that this supply pressure is completely independent of the blockchain's halving schedule. Miners continue to receive their rewards. New coins are still being created. And yet the market behaves as if the supply has been reduced. This phenomenon shows how human behavior and strategic accumulation can create effects that mimic protocol-driven scarcity. In practical terms, when large holders consistently buy and hold, smaller investors often notice the trend. They see whales locking up Bitcoin and interpret it as a bullish signal. This creates additional demand from retail investors and institutions who don't want to miss out, which further amplifies the scarcity effect. What starts as a simple decision by a large investor to hold can cascade into a broader market movement, demonstrating the power of concentrated ownership in cryptocurrency markets. Supply pressure outside protocol rules also emphasizes the psychological aspect of investing. While Bitcoin's code guarantees scarcity over time, market participants react to perceived scarcity in real time. The perception that a significant portion of Bitcoin is unavailable creates urgency among buyers, which is often more immediate and powerful than waiting for the next halving event. Essentially, whales can create the illusion of scarcity that drives price action without any changes to the underlying protocol. This is particularly relevant in markets with limited liquidity, where even moderate accumulation by large holders can have outsized effects on price. Every buy order that removes Bitcoin from exchanges reduces the number of coins accessible to other traders, which intensifies competition for the remaining supply. Over time, this kind of strategic holding can shape market sentiment and influence trends, showing that supply pressure is not solely a mechanical function of mining rewards, but also a reflection of collective market behavior. Understanding this mechanism is crucial for any investor who wants to anticipate market movements. By observing how major players accumulate and hold Bitcoin, it becomes possible to identify periods of artificial scarcity before official halving events, providing insight into potential price trends. Supply pressure outside the rules is a reminder that in cryptocurrency markets, human strategy and behavior can be just as important as protocol rules. The decisions of large holders create real-world consequences that ripple through the market, affecting not just price but also investor psychology and market dynamics. It highlights the importance of watching both the blockchain and the behavior of influential market participants, because the combination of accumulation, perception, and timing can generate scarcity effects that rival, and sometimes even exceed, the impact of scheduled halvings. By understanding these dynamics, investors can better position themselves to take advantage of market movements that are driven as much by human action as by code. Understanding why synthetic halving or strategic accumulation matters for Bitcoin's price requires looking beyond the mechanics of the blockchain and focusing on basic economic principles combined with market psychology. Bitcoin's value is primarily driven by supply and demand. When fewer coins are available for purchase and demand stays constant or grows, scarcity starts to push prices higher. Traditional halvings are predictable reductions in minor rewards that create a natural scarcity effect over time. However, when influential investors like Michael Saylor accumulate and hold large amounts of Bitcoin, they create a similar scarcity effect outside the blockchain's programmed rules. By removing a significant portion of Bitcoin from circulation, these investors effectively reduce the supply available to other market participants. This is crucial because it changes the market dynamics immediately. Unlike scheduled halvings, which only gradually affect supply over months or years, the impact on price happens because markets react to both actual scarcity and the perception of scarcity. When traders and investors notice that whales are hoarding Bitcoin, it signals confidence in the asset. The logic is simple. If someone with deep knowledge and resources is willing to hold rather than sell, it implies that Bitcoin is undervalued or likely to rise. This perception encourages more buying, which amplifies the upward pressure on price. In essence, synthetic scarcity can generate a kind of self-reinforcing loop. Large investors accumulate. The market perceives scarcity. More buyers enter, and prices rise, validating the strategy of the whales. It shows that price movements are not just the result of supply mechanics, but also a combination of strategic behavior and market psychology. Another reason this matters is that Bitcoin is a relatively illiquid asset compared to traditional financial markets. Even small reductions in circulating supply can have outsized effects on price, because there are fewer coins available to absorb buying pressure. When whales lock up significant amounts of Bitcoin, each additional purchase by retail or institutional investors competes for a smaller pool of available coins, which naturally pushes prices upward. This effect can mimic the historical bullish trends seen after halving events, which is why analysts and investors pay so much attention to whale behavior. Importantly, the impact on price isn't guaranteed. It depends on the balance between supply reduction and overall demand. If demand falters or macroeconomic conditions turn negative, even strategic accumulation may not produce a significant price increase. However, in a healthy, growing market, synthetic halving can create momentum that looks strikingly similar to the effects of an actual halving. From an investment perspective, understanding this mechanism allows individuals to make more informed decisions. Instead of simply waiting for the next blockchain-driven halving, they can observe accumulation trends and anticipate potential market movements. This is particularly valuable for investors seeking timing advantages, because the perception of scarcity often drives price before any real reduction in supply occurs. Synthetic halving also highlights the role of market psychology in price formation. While supply is limited by code, demand is influenced by perception, fear of missing out, and the visible actions of influential investors. When large players hold Bitcoin, it reassures smaller investors and encourages additional buying, creating a reinforcing cycle of scarcity and price appreciation. This demonstrates that price is not purely a function of numbers or algorithms. It's also shaped by confidence, sentiment, and collective behavior. In summary, synthetic halving matters for price because it creates scarcity, influences perception, and sets off feedback loops that can drive significant upward movement. By understanding how accumulation by major holders interacts with market dynamics, investors can better anticipate trends and position themselves strategically, taking advantage of the same mechanisms that have historically fueled Bitcoin's growth after official halving events. Investor psychology is one of the most powerful forces driving Bitcoin's price, and it becomes especially relevant when discussing synthetic halving and the behavior of whales like Michael Saylor. While supply constraints play a crucial role, human emotions and perceptions often amplify market effects far beyond what the raw numbers would suggest. When a major investor accumulates Bitcoin and holds it for long periods, it sends a signal to the market that this asset is highly valued and likely to increase in price over time. Smaller investors, watching these moves, begin to feel the fear of missing out, which is one of the strongest motivators in financial markets. FOMO occurs because humans are wired to respond to perceived scarcity and opportunity. Seeing someone with significant resources buying and holding Bitcoin creates the impression that this is a rare chance to gain, and no one wants to be left behind when the price starts moving upward. This emotional response can lead to waves of buying from retail investors, and even institutions who want to follow the trend, and in doing so, they create additional upward pressure on the price. The feedback loop is fascinating. Whales accumulate and hold. The market perceives scarcity. Retail investors rush in, prices rise, and the initial strategy of the whales is validated. This cycle demonstrates how psychology and perception are just as important as actual supply in determining market behavior. Moreover, the fear of missing out doesn't just affect individual investors. It influences broader market sentiment. News, articles, social media discussions, and market analyses all amplify the perception that Bitcoin is in high demand, which can lead to even more buying. Each wave of buying reinforces the scarcity effect, and the price begins to climb at a pace that might not be explained purely by traditional supply and demand. Understanding investor psychology also highlights the importance of timing in the market. While synthetic halving creates the conditions for scarcity, the actual price movement depends on how investors interpret and react to those conditions. Timing your entry or exit in a market driven by perception requires observing both the actions of major holders and the sentiment of smaller participants. Another aspect of investor psychology is confidence. When whales like Michael Saylor continue to accumulate and publicly endorse Bitcoin, it builds trust in the market. Investors feel reassured that Bitcoin is a safe and valuable asset, which reduces hesitation and encourages further investment. Confidence, perception, and FOMO combine to create a self-reinforcing system where the actions of a few influential players can influence the decisions of thousands of others. This effect is particularly pronounced in the cryptocurrency market, where transparency and public visibility of holdings allow investors to observe and react in real time. The psychological impact can sometimes even outweigh technical fundamentals. In money cases, price spikes occur not because of a sudden shortage of supply, but because investors collectively act on the belief that scarcity exists. This is the essence of FOMO-driven markets, and synthetic halving is a perfect example of how perception can shape reality in finance. It's also important to note that FOMO can lead to irrational behavior, such as buying at elevated prices or entering positions without proper research. While it drives upward price momentum, it can also introduce volatility and risk, which is why understanding the psychology behind these movements is critical for long-term investors. By studying how large holders influence market perception, investors can anticipate periods of heightened activity and make strategic decisions rather than reacting emotionally. The combination of scarcity, perception, and the fear of missing out creates a potent force in Bitcoin markets. When major players hold Bitcoin and the public reacts with urgency and optimism, prices can move quickly and dramatically. Synthetic halving demonstrates that market psychology is not just an abstract concept, but a tangible force that interacts with supply dynamics to shape real-world outcomes. While synthetic halving and large-scale accumulation by whales can create powerful upward pressure on Bitcoin's price, it's essential to understand that these strategies come with risks and limitations, and outcomes are never guaranteed. The first risk lies in the fact that markets are influenced by far more than just scarcity or perception. Macroeconomic conditions, government regulations, interest rates, and global financial sentiment all have a direct impact on the cryptocurrency market. Even if a whale like Michael Saylor accumulates a massive amount of Bitcoin and effectively reduces circulating supply, external factors can override scarcity effects. For example, a sudden regulatory crackdown, negative economic news, or a sharp decline in global liquidity could cause prices to drop, regardless of synthetic halving. Another important consideration is that synthetic halving relies heavily on human behavior, which is inherently unpredictable. Unlike scheduled blockchain halvings, which are guaranteed by protocol rules, synthetic halving depends entirely on the decisions of individual investors. Whales could choose to sell or redistribute their holdings at any time, releasing a significant amount of Bitcoin into the market and potentially causing sharp price corrections. The market reacts not just to actual supply but to anticipated actions, and the anticipation can quickly reverse if influential holders change strategy. Risk also comes from overestimating the psychological effect of scarcity. While perception is powerful and can drive momentum, it can be fleeting. Markets are composed of many participants with diverse motivations, and not everyone will react as expected. Over-reliance on the scarcity created by whale accumulation without considering broader market conditions can lead to misjudged strategies or financial losses. Liquidity is another factor that must be considered. In times of high volatility, even synthetic scarcity may not protect against sharp price swings. The cryptocurrency market can experience sudden corrections, panic selling, or unexpected surges that outpace the perceived scarcity effect, demonstrating that synthetic halving is not a foolproof mechanism for ensuring gains. Moreover, while synthetic halving mimics the effect of a natural halving, it cannot replicate the long-term confidence that comes from Bitcoin's protocol-driven supply schedule. Investors often rely on the predictability of the blockchain having to plan strategies, and while synthetic scarcity can influence short-term trends, it may not sustain long-term growth in the same way. Another risk is that FOMO-driven buying can create bubbles, where prices rise beyond reasonable valuations simply due to perception of scarcity. When the perception shifts or whales change their behavior, these bubbles can burst, leading to rapid declines and financial losses for investors who entered late. Understanding these dynamics is crucial for anyone participating in the cryptocurrency market. It highlights the importance of diversifying strategies, conducting proper research, and not relying solely on the accumulation patterns of a few individuals. Investors must weigh the potential benefits of synthetic scarcity against the inherent uncertainties and external factors that influence the market. This reality check also emphasizes that while watching whale behavior can provide valuable insight into market trends, it should never replace comprehensive financial planning or risk management. Market movements are complex, and even large-scale accumulation cannot guarantee specific outcomes. Finally, investors should remember that cryptocurrency is volatile, And synthetic halving, while an interesting and powerful concept, is only one of many forces at play. Long-term success requires understanding the interplay between supply dynamics, investor psychology, macro conditions, and individual risk tolerance. Recognizing the limits of synthetic halving allows investors to make smarter decisions, anticipate potential pitfalls, and approach the market with a balanced perspective, combining optimism about scarcity effects with caution about unpredictable market realities. So, when you put it all together, what we see is that Bitcoin's price isn't driven just by protocol rules or scheduled halvings. Large investors like Michael Saylor can create scarcity through strategic accumulation, which mimics halving effects and influences the market in real time. This synthetic halving impacts supply, fuels investor psychology, and triggers FOMO, creating cycles of buying that can push prices higher. At the same time, it's important to remember that these strategies come with risks, market conditions, external factors, and human behavior are unpredictable, and no accumulation strategy can guarantee outcomes. The takeaway is that understanding how scarcity, perception, and whale behavior interact gives investors a deeper insight into Bitcoin's price dynamics, but it should always be combined with careful research, risk management, and awareness of the bigger picture. By observing both the fundamentals and the psychology driving the market, you can position yourself to make smarter, more informed decisions rather than simply reacting to trends.